Welcome everyone. A few weeks ago we talked about how Social Security benefits are taxed. During that discussion I promised to follow up discussing a common tax trap that relates to Social Security. So that's what we're talking about today, specifically the so-called Social Security tax torpedo. Let's get into it. If you're new to the channel, I'm Ted Erhart. My professional focus is retirement planning for individuals typically over 55. One of the biggest mistakes I see people make is focusing solely on their investment portfolio. Now, obviously, the investment portfolio is important, but there are other extremely important factors like the timing and coordination of Social Security benefits, not to mention tax strategy. So when I'm working with individuals, I really strive to ensure that all these factors are not only taken into consideration, but working together. So if you're thinking about retirement and you want to have a conversation, please feel free to reach out. Now let's get into today's topic. Now again, we talked about how Social Security benefits are taxed a few weeks ago, and I'll link to that up here if you're watching on YouTube. Now the way benefits are taxed is actually kind of complicated, and again, go back to that other video if you're looking for a deeper explanation. But at a high level, basically, it depends on your level of income. So you can see up on the table here are the brackets for determining how much of your Social Security benefits are taxable. If your income is actually low enough, and let me just note this is for married filers, and again, if your income's low enough, none of your Social Security benefits are going to be taxable. But if your income's high enough, specifically over $44,000, up to 85% of your benefits can be subject to income tax. What we're focusing on today is if you're somewhere in between these brackets, because that's where the so-called tax torpedo lies. Let me just mention a few things on the taxation of Social Security, specifically with these brackets. I really want to emphasize that these brackets aren't rigid. So for example, if you exceed $44,000 of provisional income and you're a joint filer, 85% of your benefits don't suddenly become taxable. It's a gradual phase in, and it depends on your level of income. So this grid actually does a very good job of demonstrating how the phase in works. So for example, if you and your spouse have a combined $40,000 of Social Security benefits, plus say $36,000 of other retirement income, so we can grid that out and see that about 41% of your Social Security benefits are going to be taxable. And as you can see, as the percentage of taxable benefits, you can see as your income increases, the percentage of your taxable benefits goes up to a maximum of 85%. And to be clear, this table isn't saying that you're paying an 85% tax rate. It's saying that 85% of your Social Security benefits will be subject to income tax. So that's an important distinction. Now, let's get into what's been coined the Social Security tax torpedo. So this is one of those quirks of the tax code that can catch people off guard. Now, to be clear, the tax torpedo exists only when you're right in the midst of this phase-in of taxable Social Security. So once your income's high enough and 85% of your benefits are taxable, you're down here on this grid, the tax torpedo is no longer in play. It's only an issue, again, if you're in between these brackets. And here's the problem. When you're in between brackets and you start stacking on additional taxable income, the problem is not only is that additional income being taxed, but it's resulting in an increasing amount of your Social Security benefits that are becoming taxable. So let me just give you a real-world example that I recently encountered with one of my clients to demonstrate the tax torpedo in the real world. So we'll call these clients Bob and Mary. Bob recently called me and said, hey, I have some upcoming expenses. I'd like to take a $20,000 withdrawal out of one of my pre-tax retirement accounts. So I said, okay, no problem. Why don't you first send me your most recent tax return if you think it's going to be a good proxy for your income in 2022. Bob said, sure, no problem. So he sent me his most recent tax return. When I evaluated that, here's what I found. So Bob and Mary had about $42,000 of retirement income, which consisted of some IRA withdrawals and pension. They had $56,000 of Social Security benefits, and the way the math worked out with this combination of income and Social Security, about half of their Social Security benefits are subject to tax. So I wanted to figure out if Bob and Mary layer on another $20,000 of taxable income, how is that going to impact the taxation of their Social Security? Well, it's going to increase their retirement income up to $62,000, and we'll just keep their Social Security benefits even to keep things simple. But basically, this combination of income and Social Security benefits means that $17,000 of additional Social Security benefits are going to be subject to taxation. So in other words, a $20,000 IRA distribution for Bob and Mary is going to be taxed as if it was a $37,000 retirement distribution, because more of their Social Security is becoming subject to taxation, because again, they're right in the middle of that phase-in of taxable Social Security benefits. This is a perfect demonstration of the tax torpedo at play. So naturally the question is, what can you do about this? Well, it obviously depends on your situation, but generally speaking, my answer is always going to be planning, planning, planning. In the case of Bob and Mary, I could have just fulfilled the request and sent them their $20,000 out of their IRA, and then next year they would have had a pretty nasty tax surprise. Fortunately, I was very proactive. I said, let's take a look at this. Let's actually kind of mock up the numbers and see what types of tax implications this is going to have. And I identified immediately they are right in the tax torpedo zone. So fortunately in their case, they had some other accounts, and I said, look, we can take some withdrawals from here, and basically we're going to avoid all these tax implications. And that's ultimately what we did. So planning, planning, planning is the best solution for avoiding the tax torpedo. So clearly the tax torpedo can provide some very unwelcome surprises if you're someone who's right in the phase-in of taxable Social Security benefits. Sometimes, depending on your circumstances, there's not much you can do, but at the very least, plan ahead, because even if you're going to get stuck in the tax torpedo zone, at least you'll be ready for it and won't be mad when it's time to file your taxes. So look, this was a more technical discussion today, so way to go if you made it all the way through. I mentioned that retirement planning is our bread and butter, so if you're interested in a discussion, please feel free to check out our website and reach out. Happy to have a complimentary discussion with you. Thanks for watching. I hope we'll see you on the next one.